Let me ask you something you've probably thought about but never actually calculated. What's your book worth? Not what you've earned this year in renewals. If you wanted to sell your book tomorrow or transition out in the next 6 to 12 months, what would someone actually pay you for what you've built? If you're like most experienced advisors, you probably have a vague number in your head, maybe 2 times your annual renewals. Maybe you've heard others got 1.5 times or maybe 2.5 times. But here's what I want you to understand. If you generate $100,000 or more in annual renewals, your book represents between 1.5 million and 2.5 million in future income over the next 10 to 15 years. That's the mathematical reality that renewal stream keeps flowing year after year. You've built something generally valuable. But here's the problem. The traditional insurance industry has absolutely no intention of paying you whatever close to that value, the standard bio in this industry. 1 times annual renewals paid over 3 to 5 years with clawbacks. If clients lapsed and you help with a transition for free, if you have a 150,000 renewal stream worth 2.5 million in future income, they'll offer you a $150,000 spread over 5 years with strings attached. That's theft, with paperwork more so than a buyout. And every single day you continue without a proper exit strategy, you are leaving real money on the table that you'll never get back. If you're an experienced insurance advisor who's been in this business for 15, 20, 30 years, you've built a renewal stream generating $100,000 or more annually. If you've ever wondered why your book of business feels more like a job you can't leave than an asset you can sell, then what I'm about to share could change everything. Because I'm going to show you how advisors, just like you, are finally capturing the real value of what they've built with a contractual exit strategy that pays them 75% of their renewals for a 10-year period. And at the highest level, their beneficiaries continue to get paid in perpetuity. This isn't about working harder or prospecting more. This is about making one strategy decision that turns your book from something you've trapped servicing forever into an actual asset with contractual value that you control. My name's Jim Chamberlain. I've spent 37 years in the insurance free, including 22 years as a manager for a major carrier. I've built agencies. I've scaled production teams. I've seen every side of this business. But more importantly, I've watched the industry systematically undervalue advisors' books for decades. I've seen talented producers get offered insulting buyouts. I've watched advisors work into their 70s because they have no real exit options. And I've decided I wasn't going to keep participating in a system that treats advisors like replaceable parts instead of business owners who've built real assets. Before I can properly explain how this buyout program works, you need to understand what most advisors never capture: the real value of their books. Problem number 1. The industry built a system that keeps you trapped. Think about every other business in America. A restaurant owner generating $200,000 in annual profit can sell their business for 3 to 5 times earnings. Software companies, 10 to 20 times annual revenue. But an insurance advisor with a $150,000 renewal stream, that will generate over $2 million the next 15 years. You're only offered 1-time annual renewals if you're lucky, and that's paid over years. Why the massive discrepancy? Because the carriers have normalized insulting buyout offers so consistently that most advisors don't even question it anymore. You've just accepted that 20 or 30 years of relationship building is somewhat less than 12 to 18 months of income. Problem number 2, your exit strategy really doesn't actually exist. Let's talk about the plan. Most advisors have finding a younger advisor to buy their book or sell it back to your agency. Or maybe one of the kids will take it over. Except here's what actually happens. The younger advisors can't afford to pay you up front, so they want earns based on retention, which means you are gambling their service and your clients properly. Your agency offers pennies on the dollars because they know you have no other options. Your kids, they have their own careers, they're not getting licensed. So here you are, in your 60s, 65, maybe 70 years old, still working because you never actually solved the exit problem. You don't have an exit strategy. You have hope, really misguided plans. Problem number 3. Every year you wait. Your cost of real money erodes if you're 55 with 120,000 annual renew. You wait 5 years to implement a proper exit strategy. You just gambled away $600,000 in unprotected income. Those 5 years of renewals have no contractual protection, no buyout structure, no succession plan every month without a proper exit. Strategy is a month of value you're gambling with, and the longer you wait, the fewer options you have. Your book's average client age keeps increasing, making it less attractive to buyers. The opportunity cost of waiting isn't just the unprotected income, it's the declining value of the asset itself. Now, if you're recognizing yourself in any of this, if you've been putting off dealing with your exit strategy because the options all seem terrible, here's what I want you to understand. There is a better way. There's a contractual exit strategy that pays you what your book is actually worth, but you have to stop accepting what the traditional industry offers. I am developing something for agents nobody else offers, a contractual legacy program that actually pays you what your book is worth, not one-time renewal spread over 5 years. A program that pays you 75% every renewals for a full 10-year period when you exit, and at the highest level, your beneficiaries keep getting paid at 25% in perpetuity. Let me break it down exactly how this works. The legacy program, your actual exit strategy, there are 3 levels: bronze, silver, and gold. Each offer an increasing protection bronze legacy ownership. Once you consistently generate at least $500 a month in renewals, you qualify. Here's what that means. If you retire, become disabled, or die, you or your named beneficiaries, you receive 75% of your renewal income for a 10 full-year period, not based on client retention, not with clawbacks. 75% for 10 years, contractually guaranteed. So if you're generating $10,000 per month in renewals, that's $7,500 per month for 10 years. Compare that to the traditional industry offering of one-time annual renewals, $120,000. In this example, you are capturing 7.5 times more value. Silver legacy, same 75%, 10-year structure with higher production thresholds. Gold legacy. This is where it becomes generational wealth. 75% for 10 years, then 25% indefinitely. Your beneficiaries can take over the business if they get licensed, or take 75% buyout and let your agency service the clients. Let's do the math. If you have a $150,000 annual renewal, stream and reach gold, legacy 1 through 10. Receive $112,500 per year, and that's $1.125 million over that 10-year period. 11 years forward, you receive $37,500 per year indefinitely. If your beneficiary lives for 20 years after an initial buyout, that's an additional $750,000 total value, minimum of $1.875 million. Compare that to a traditional buyout of $150,000 to maybe $300,000 paid over 5 years. With clawbacks, you're capturing 6 times to 12 times more value. But here's what makes this powerful right now. This program makes your book valuable today. Right now, your book is only worth what someone is willing to pay with the legacy program. Your book has contractual value that protects. Regardless of who wants to buy it, you've turned your book from a job into an asset with contractual value. Here's what working with me looks like. You keep your independence. You own your book. From day one, you get access to top carriers across life, annuities, living benefits, estate planning. You get competitive compensation that rewards both personal production and team building. You get hands-on mentorship from someone with 35 years of experience. And most importantly, you get a contractual legacy program that finally gives you the exit strategy you deserve. Here's what I want to offer you. I want to invite you to a Schedule A legacy calculation strategy call with myself. This is a one-on-one conversation where we'll do 3 things. First, calculate the actual value of your book based on your renewal stream and what that represents over a 10 to 15-year period. Second, map out what your exit strategy could look like. with the legacy program. Actually, how much you receive for how long. Third, discuss whether the legacy program at the Chamberlain Xperia Group is the right fit for your situation. You'll leave knowing precisely what your book is worth and how to capture the value contractually now. Let me share what happened with advisors who made this transaction. Michael had a $180,000 renewal stream built over a 23-year period. His carrier offered him $180,000 one year's income paid over 5 years with clawbacks. After qualifying for Gold Legacy, his exit value went from $180,000 to $1.35 million guaranteed over 10 years, plus ongoing income at 25% indefinitely. Sarah was 62 years old with a $140,000 book and had been trying to find a buyer for 3 years. Every buyer wanted earn-out terms that made her gamble on their ability to retain clients. After joining the Legacy program, she's 18 months from the Gold Legacy. Her exit strategy is now locked in contractually. No hot hope, an offer to buy her out. David was 67 years old with a $210,000 renewal stream. Succession planning firms told him, "We can get you 1.5 to 2 times annual renewals paid over 5 years. That would have been $315,000 to possibly $420,000 from an asset generating $2 million plus over 10 years after reaching Silver Legacy." His contractual exit value is now $1.575 million. Over a 10-year period, he went from capturing 20% of his book's value to capturing 75% guaranteed. From a purely logical standpoint, this is the smartest business decision you could ever make. The only question is whether you're going to capture 20% of its value through traditional channels or 75% on a contractual legacy program. This isn't about starting over. This is about positioning what you've already built into a structure that pays you what you are worth. Here's what you need to understand about time. Every month you wait is a month. Your book has no contractual protection and no really verified exit value. The legacy program rewards you for building business now. The more you grow your renewals and overrides, the higher your exit value becomes. But you have to be actively building to qualify if you want. If you wait until you're ready to retire to figure out your exit strategy, you've missed the opportunity to maximize your legacy value. Plus, let's be honest about where the industry is heading. Compliance requirements keep increasing. Carriers are tightening the bio terms. The traditional path to monetize your book is getting worse, not better. Here's exactly what you need to do right now. Click the button below, schedule your legacy calculation strategy, call with me. We'll spend 45 minutes together and I'll show you how exactly what your book is worth and how to capture that value contractually. You'll leave with a calculated value of a book value over a 10 to 15 year period, a clearer picture of what your legacy program buyout would look like, and a complete understanding of your exit options. No pressure, no obligation, just clarity. Don't spend another year without a real exit strategy. Don't leave $500,000, $1 million, or $1.5 million on the table. Click the button and schedule your legacy calculation strategy. Call right now. After 37 years in the industry, I can tell you with certainty, the advisors who take control of their exit strategy and demand what they're worth are the ones who capture the value they've built. You've built some. Now let me show you how to get paid what it's actually worth. Schedule your call now. This is Jim Chamberlain, and I look forward to helping you capture the real value of your book. You've spent your career building, your exit strategy is waiting. All you have to do is claim it.